Good evening and welcome to our High Street Finance Centre webinar for the 29th of November. Thanks very much for joining us, and we're sure that you're going to get a lot out of this. Joining me today is Peter Maver. Peter is a broker with Esdale Sinclair who focuses on commercial deals. So he's right at the coalface, as you would say, in respect of what is happening in the commercial area of Central Queensland. And Peter and I have had a number of interesting discussions about where the economy is heading, and particularly the economy of Central Queensland. So I thought, well, he's probably a good guy for my clients to be able to get some idea of what's happening, what's likely to happen, and just to get a feel for how it's going to impact our individual business clients. So, Peter, thanks very much for joining us today, and away we go.
Yeah, hi everyone. I've got to give you a bit of background. I spent about 10 years working in the Brisbane Gold Coast growth corridor, mainly with property developers, and as you would appreciate, with the type of deals I was involved in, there were what are referred to as mid-market, which is a construction or development cost value of between $5 and $100 million. Timeframes for these projects were anything from 18 months to 5 years. So trying to pick what was coming was pretty vital to us. There's no point building something if by the time you finish it, nobody wants it. So from that and my previous experience, I've been a developer on my own and other things, I always have or keep in tune with what I suspect is going to come in the future. The way I do that is I look at three levels. I look at what's happening globally, I look at what's happening nationally, and then I look at location specific. In this particular case, we're going to talk about Central Queensland. So what's happening in the global economy? Well, as you've probably seen from the media reports, the US and Europe, to cut the chase, will effectively be bankrupt by the end of next year, is the general feeling. They will be reverting to effectively a third world economy, and they have their own series of issues with that. Conversely, what are referred to as the emerging markets, or sometimes you'll hear them referred to as the BRICS, which is Brazil, Russia, India and China. All of those countries are going from being third world countries to first world powers with first world economies. I was at a briefing last week where Macquarie Global advises that Nestle, the makers of Smarties in Australia, advise that over the next 5 years they will gain 1 billion extra customers. I'd like you to imagine 1 billion packets of Smarties. I'd also like you to imagine the amount of energy needed to make those, the transport, the raw ingredients, getting it to the point of sale, getting rid of the rubbish, the full circle. It's a huge, huge issue. The Chinese have a curse. May you live in interesting times. We definitely do. We are seeing effectively what's now considered to be the Western economies go from a position of superiority. I won't say a position of inferiority, probably more a position of equality with the BRICS. So how did we get to this point? It's important that you understand how we get here, and to understand that you need to understand the global financial crisis. It's something everyone talks about, but no one really explains to people how it happened, why it happened. The short version is greed. Ninja loans are probably the best example of this. They stand for no income, no job, no asset. These were loans that were designed for hedge fund managers who use a thing called high frequency trading. There's a thing called securitisation as a general product name, and within securitisation the product they sell is called a CDO, a collateralised debt obligation. Our friends on Wall Street would sell these collateralised debt obligations. Now this would consist routinely of a packet of home loans, car loans, equipment finance loans, any form of loans, including credit cards. They would all be packaged together and sold in parcels of about $1 billion minimum. Our friends on Wall Street would put these deals together. They would take 30% of the $1 billion as their commission. So they had some pretty sound financial reasons, personal financial reasons, to make these things work. Where they were selling them to was to hedge fund managers. What a hedge fund manager is it's someone that's used by superannuation funds and other investors to make them money. Their job is they get given a chunk of money, go out and make more money with it. So what they would do is they would buy a CDO at a face rate, for the sake of our discussion, of say 5%. You'll have to trust me on the maths with this, but the way the maths works is that our friends on Wall Street, after paying themselves a $300 million commission, would have to charge about 7.14% to the end borrower as an interest rate. Sound familiar? Sound like home loan rates over the last 5 or 6 years? That's the reason why. So what do the hedge fund managers do? These great guys would grab the money and go to the superannuation fund and say, we've got this really safe investment. It's American real estate, home loans. We've got it, all the risks are covered. You haven't got an issue. The ratings agency would give it 3 stars or AAA rated or whatever measure they use. So everybody was happy. What the hedge fund managers were doing, or how they were making their money, was that they were grabbing the payments. Just for the sake of this analogy, let's assume that they're getting in $1 million a day in payments on that $1 billion loan portfolio. What they would do with those payments is that within their agreements they were able to use the money. Now they would have access to that home loan payment for somewhere between 4 hours and 24 hours. They would use what's referred to as high frequency trading. Now depending on what reports you hear and read, there are estimates as high as 80% of the trading volume of the New York Stock Exchange is these high frequency trades. A high frequency trade is generally defined as where the shareholding is for less than 1 second. So what these guys would do is they would then gear up their $1 million. That is, you're probably familiar with gearing if you've ever had any share market investments. They would gear that up, so they might have $3 million, of which $2 million was borrowed for the period that they were in the market. Their aim was to earn about 0.5% interest per day, which if you work on 280 days, trading days per year, is 140% interest rate. It's not a bad return when you haven't put 1 cent into it. Most of these guys operate from their homes. A few of them actually open up offices. Generally they got big enough. Now the origins of the ninja loans was that they were originally doing these CDOs just using standard home loans. The trouble with standard home loans from the hedge fund manager's point of view is that some people make their payments early, some make them late. So they couldn't rely on getting an exact $1 million every day. So what they thought, or the boys on Wall Street come up with, is we've got this great product, we can lend to people, they don't have to make any payments, we'll capitalise it, in other words put the payments on top of the home loan for 5 years. It gives them a nice, steady, strong cash flow. No problems. The end borrower, who really cared? Probably the best example I saw of this was there was an 11,000 what we would call unit development in Florida. Now they call them condos. Every one of those 11,000 units was done as an ninja loan. They were literally selling them to beggars in the street, and they were saying, look, sign this paperwork and you get to live in this brand new luxury unit for 5 years. You don't have to make any payments. And at the end of the 5 years, well, we all know real estate goes up. You'll sell the property, pay out the loan, and you'll probably pick up some money out of the deal. So away we went. What followed, we all know. But the point of giving you this example is this is the extreme lengths of greed, and the fact that it wasn't just one particular entity. It was your superannuation fund chasing a high return. It was the Wall Street guys chasing a high return. It was the hedge fund managers chasing a high return. The various government agencies, both within Australia and overseas, all failed in their duty of care. That is without doubt and without dispute. It's all unravelling in America at the moment, and if you're really interested, I would suggest you Google a thing called MERS, just M-E-R-S, and just sit back in amazement and see what's going to happen. It's unfolding, and it's going to be very, very nasty and very, very messy. Okay, so that's all the bad news. Now we know how we've got here, and we know to look out for anyone that calls himself a hedge fund manager or tells you that they're from Wall Street. You see one of those running the other direction, count your fingers. There's a good chance one of them will be missing. Okay, on top of that, we're now moving from one business model to another. I define these as the American model, which is you put nothing in, you lease the premises and equipment, you hire temp staff, and you price everything with a margin, and you're working on what's referred to as a rising market. In other words, the market is growing. Probably the easiest item that fits that profile now would be iPhones. Everybody wants one. People are literally paying 2 or 3 times a comparable phone, and they can't keep up with the volume. That's just the way it is. And it's a great model, it works, unless the market's falling. The market we're going back to is what I refer to as the Scandinavian market, and was the market that Australia operated until probably the late 70s, early 80s, when we floated the Australian dollar and started the change over to the American business model. Under the Scandinavian model, you own everything. You have at least 3 years working capital, you employ your staff for life, and you understand that markets have ups and downs. Probably the best example of that is IKEA. The other one is the South African grocery company Aldi. They own everything. That's now giving them a competitive advantage because they don't pay rent, they don't pay interest, which means that their costs are dramatically less. The other thing obviously is if you're running your own business at the moment, and if you had 3 years working capital sitting around, you'd be feeling pretty happy. You know, if you're on the American business model, you'd be probably pretty worried at the moment. Obviously in Australia, we don't go, well, there'd be very few businesses that are at either extreme. We all fall somewhere in the middle, and I've just recently left Suncorp as a business banker, and I can assure you from about 2009 on, the conversion from people from the American model to the Scandinavian model was evident. We saw businesses suddenly buying equipment, not financing it. If they had things on finance, if they didn't need them, they were selling them, grabbing the cash and solving them away on a term deposit, or paying off their home loan, or paying off other loans. I think in the last 12 months I was with Suncorp, every deal I looked at on their home loans, they were a minimum of 6 months in advance. Credit card usage has just dropped to a fraction. I think, again, if you go to the Australian Bureau of Statistics, I think credit card usage has dropped by nearly 40% the last time I remember reading a report, as people clear their credit cards, don't seek bigger limits, all the rest of it. All of those things are symptomatic of the conversion from the American model to the Scandinavian model. Okay. So that's the sort of global situation. Now the national situation. Nationally, we've been mugged in a meadow. We had 15 years of drought and we had 15 years of a boom. Being in the construction industry, I watched one of the standard things we had in construction contracts was what's referred to as a wet weather allowance. We watched those shrink from 2 or 3 months to 2 or 3 days to, at one stage, they weren't even mentioned. This was symptomatic of both the drought and also the boom. So we now have to go back to the real world, for want of another phrase, which means that things go up and things go down. I suspect the next 12 months is going to be very difficult for everyone. I thought Central Queensland would be immune to it, but information or announcements made literally within the last 24 hours lead me to believe we will feel the winds of this. We will not suffer the way they will in the southern capitals. Those places are going to really get slammed. One of the things I should also mention is that I'm expecting a dramatic influx of refugees from Europe and America, economic refugees. A thing I saw on the ABC last week was there's a Greek-Australian Business Association down in Melbourne at the moment they're fielding between 2,000 and 3,000 immigration inquiries per week just to Melbourne out of Greece. There will be the same numbers coming out of the rest of Europe, and I include the UK in that. Okay, so that's going to add to our mix. That's going to have some positive impact, I believe. They will bring a lot of different ways of doing things, some that will be good, some that will be great, and some that will be, well, who cares? We need to be aware of that. We will see these people up here, particularly the professionals that are linked to the mining and resources industry. I think what you will find is where today in Central Queensland and mining resource projects where everyone's screaming for workers, next year, probably by the middle of next year, they will have the opposite problem. There'll be more qualified people than they have jobs for. Okay. As you've probably been seeing in the media literally last night and today, Mr Swan is now talking about the government being in a deficit. There are a number of reasons for this, but what we're going to talk about right now is the coming credit crunch, which again has been fairly widely reported in the general media. There are a number of reasons why it's going to come, and I won't bore you with the detail, but it is coming. We're going to see what's referred to as credit rationing. That means that people would normally get loans approved, will either get straight declinals, or alternatively, we need you to put in 50%, we'll do the deal. This is going to lead to funding shortfalls for businesses, particularly those that wish to expand, that were relying on the American model or debt to fund their expansion. The other thing is you're going to see costs of funds increase. As the banks walk away from lending, other entities will emerge that will fill the gap. There is a lot of money in Australia tied up in self-managed superannuation funds. There's been a great relaxation of the rules with self-managed superannuation funds, and I can see emerging what I refer to as pass-the-hat-round finance. Basically, an example of pass-the-hat-round finance is that you might have a relative that has a great idea. They want to buy a McDonald's in Rocky. They need to raise some money, so they tap you on the shoulder and say, well, can you put in some money towards buying McDonald's in Rocky for me? Those sorts of deals will start to emerge. They've already been happening for the last 2 or 3 years in greater numbers because of changes to the legislation in relation to consumer lending. There's a thing called the National Consumer Credit Code, which basically has made life more interesting for everyone. And I would probably suggest if you just type in National Consumer Credit Code in Google, you'll see some of the examples. Okay, to counter out that, the government obviously will want to be trying to stimulate the economy, and they'll be bringing in interest rate cuts. So you're going to have this dichotomy that the banks won't be lending money, but what they do will be at lower rates. Money will be available, but it'll be pass-the-hat-round finance type money where people will want a return, either a percentage of profits or an interest rate, which obviously, because there's more risk as far as these people are concerned, will be at a higher rate than you'll get from the bank. Interesting times. So we shift from the American to the Scandinavian model. Normally I would like to see that sort of happen over about a 5-year time frame. I tend to think we're going to see that happen over 12 months. Okay, so what's that going to do on a national basis? We're going to see these economic refugees hitting Australia. We're going to see businesses relocating to where the work is, where the money is. They will also, you'll actually see businesses, in my opinion, relocate from places like the US and also from Europe, and they will have to upskill Australia. We will be going back into manufacturing in a big way, is my view, purely because we are a supply base. I have anecdotal advice from a former client of mine who's a steel fabricator that there are 4 refineries, smelters, tipped to be built between Gracemere and Gladstone. These 4 will take up that entire land, have about 5,000 people per shift, 3 shifts a day. It makes sense to make the stuff where you're digging it out of the ground or you're growing it. And Central Queensland, from that point of view, we do that. In the case of the Smarties, we grow the timber that makes the packet. We've probably got the right conditions to grow the cacao, which is the bean they actually use to make chocolate. We grow sugar cane, so you've got the sugar coating. We've got the steel to make the manufacturing equipment. All of that you can do without moving outside of Central Queensland. We are probably one of the few places in the world where that holds true. So I can see that more and more of that. Whether it gets down to actually manufacturing things like Smarties, don't know. The bigger stuff, smelting, absolutely. One of the risks for us now is that Australia will be seen as a supply base for China and India and the emerging economies, and we need to be aware of that. Okay, let's drill down to the local situation, or street level as I like to call it. We've seen the history and we've read the forecast. What does it mean? Well, one thing I've learnt in property development is you have to turn every negative into a positive, or find a way. So if it's a problem, how do you make it an opportunity? You need to change your thinking around. So, on the street level, how can you tell if I'm right or wrong? Well, look for these badges. What we should see is suddenly more European cars. Any of you based in Gladstone, the Audi logo, which is those 4 rings on the right-hand side, you'll see a number of 4-wheel drives with those floating around Gladstone. If you think about it, what's called entry level, or as we used to call it, poverty pack, Audi 4-wheel drive start about $140,000. So basically you're watching a house drive past you. Think about that. Okay, same thing with the others, and I've actually started seeing my first Porsches in Rockhampton and Yeppoon in the last month, which just blows me away, because I'm seeing not only the 4-wheel drive Porsches but also the convertibles as well, and again, you know, your entry point's about 180 grand. That means there's some serious players here. Generally don't expect that they're cowcockies or locals, not the type of profile. These will be the badges you will see, particularly with the Europeans that move in. I've heard that there are 4,000 engineers being recruited to work and live in Gladstone. They will change this Central Queensland. You've got 4,000 engineers plus their families. They've been told they're going to be here for 5 to 15 years worth of work for these various projects that are either coming, underway, or what have you. They'll be coming from Europe, Canada and the States, and the expected income, or the average income, is going to be about $350,000, plus I'm told they get a $50,000 a year housing allowance. But that's not all. If you have a look at the attached slide, or the following slide, these are the projects that are underway. Okay, so how does this affect you and me? Okay, so you need to be prepared for the economic refugees. They're going to change Central Queensland in ways that basically I don't think most people will believe. You're talking about people that are used to living in London and Paris and Rome and Berlin. The cafe culture, the restaurants, the clothes, the shopping, all those sorts of attitudinal changes they will bring. It'll be quite an interesting dynamic watching them adjust to us and us adjusting to them. Real estate demand should bloom. I can't see people earning that level of income renting. If you're going to be here for 5 to 15 years, particularly with what's happened where they've come from, they'll want security. Security means owning your own home. May not be financially the best thing, but mentally you're always better off in your own home, preferably debt-free. The mining resource boom will continue. Not to the level I think people have in their own minds. You need to actually look at what's happening on the ground, follow what BMA, Rio, Xstrata are actually doing. Don't listen to the words, look at the actions. There'll be a food resource boom. With the collapse of the EU, we'll go back to where Australia was pre the creation of the EU in the 60s, where we were the food basket for Europe, and I expect that to resume. Perhaps not to the same extent, but definitely heading that way. So, putting my old developer hat on, when opportunity knocks, you've got to recognise it. You've got to have the courage to act on it, and you've got to have the guts to deliver it. What do I mean? Well, the easiest example in the last 6 months is the opening of the Myer store in Mackay. If I'd come to you 6 months ago and said Myer is putting in their largest shop in Australia in Mackay, you would have laughed at me. But they have, they did, they have. So, anecdotally, I'm hearing that the store in Mackay is outselling all of the stores in Melbourne or Sydney, which is just phenomenal. That will attract more attention to Central Queensland. Okay? So, how can the people in Mackay react to this? I know the retailers will throw their hands in the air and say they're going to steal all our business. Well, no, they won't. Yes, they'll take some of it, but all you need to do is position yourself where Myer isn't. So Myer isn't generally in the bottom end El Cheapo stuff. It's not in the workplace stuff, our favourite fluoro safety vests and shirts and what have you. There are lots of opportunities. What Myer is doing is it's acting like a vacuum cleaner for retailers. It's sucking the life out of every other town in CQ because, and I don't want to be a misogynist here, but women like shopping, men like fishing. So if you can drive to Mackay with your wife and you can drop her off to go shopping while you go fishing, my guess is that's what's going to happen. And again, opportunity. People that grab that opportunity, recognise that's what's going to happen, can maximise the benefit. So if I owned a four-wheel drive store, or if I owned a fishing bait and tackle store at the moment, I'd be looking for more space and looking to expand my range and my stock. Because you know, with Myer in town, the other big retailers will move in after them. It's a big threat to every other town in CQ. What you need to do is work out how you're going to address that threat and turn it to your advantage. That's the trick. So that's it from me, and I'll hand back to Allan, and I hope I haven't bored you all to death.
Thanks very much for that, Peter. I'm sure all of that is very interesting, and certainly we need to be aware of what's happening and being ready to make the most of the opportunities that are now presenting to us. So thanks very much, Peter. Before we go, actually, I was just wondering if you'd like to just have a few words on this latest project of yours in terms of the Kokoda Trail. Sure. Some of our clients might be interested in just finding out what's going on with that.
Absolutely. Yeah, I have another hat, which is I'm on the fundraising team for the Yeppoon Coast Guard. I've come up with a concept called Operation Choco, which is named in honour of the original guys that fought on the Kokoda track. It's a fundraising event for the Coast Guard, which is now spreading wider and wider. At the moment, it's all of the Coast Guards in Central Queensland. I suspect it'll end up being all of the Coast Guards in Queensland. The concept is we take the 6 most hated professions and we get them to train for and then complete the Kokoda track. Kick-off is at this point in time the first Thursday in February, with us hitting the track itself on the 9th of August. So watch out for it, Operation Choco. Really appreciate your support. If you want to get involved as a sponsor, would love to hear from you. Just email me maverick@esdalesinclair.com.au. We are looking for sponsors. There'll be 3 events per week for 6 months. So at the moment there's 72 events. We're planning to have a roving one on Tuesdays, every Thursday night at Stocklands, and every Saturday morning at Yeppoon, probably on the beach. Yeah, thanks, Allan.
Sounds interesting, Peter. All right. So thanks very much for attending our webinar. Hope you've enjoyed that. If you've got any questions, of course, just let us know, or any comments. We'd love feedback. So thanks very much, and we'll catch you next time.